Rakib, hey Dave. So thank you so
Hello.
much for being here. Really glad to have you here. This is the first podcast that we're doing for Mantis. I'm Kriti. I'm the founder of Mantis, and we are an ARR reporting and forecasting tool for SaaS and consumption-based companies. We're here today to discuss how SaaS business models are evolving over time and how they are transforming the way we look at metrics. So yeah, really glad to have you here. Would love if you can also introduce yourselves and we can then jump into it.
Thank you. I'll kick it off. Rakib Azad. I'm CFO at Alkira. I've been here for about 5 months, so relatively new. And the best way I could describe the company is we provide cloud networking as a service and has a very big usage-based component to it. So I look forward to chatting about it and my past experiences.
Perfect.
Cool.
Here.
Nice to meet you, Rakib. I'm David Woolliscroft. I'm the CEO of a consulting company called Exit Point Partners. My background has all been in finance and consulting. I used to work as a managing director at Deloitte, been a CFO in the past. I worked in private equity as a CFO operating partner. And now we work with growing SaaS companies to help drive profitable, efficient growth. So very happy to be here today.
Thank you, Dave. So what we've seen across over the last few years is that SaaS business models are really evolving. They're becoming a lot more mature. They're not as simple as what we had seen a few years back. So would love to hear from both of you. What are the different kind of models that you have seen in your current company, in your previous companies, and how do they vary across different stages, and what are the pros, cons of each model? Rakib, do you want to kick this in?
Sure. I mean, so the origin of SaaS is, delivering software as a service, right? Where you are not owning the actual software itself, and you're basically, have a license to eat software, right? That's been the origins of the SaaS world, maybe starting in the mid 2000s. And for me, I've been in a couple of companies where this has evolved quite a bit. So my past experiences include MongoDB and chain analysis, and now with Alkira. And we are in all three companies, we've evolved to transaction usage-based type models. But they permeate in different ways, right? And so some of it you price based on consumption, some of it you still have potential license governed by transactions. So it is interesting how companies are going to market now. Within the same company itself, you may do pricing models that are your classic license versus usage-based, right? And sometimes it's going to where the customer is going. But it's fascinating to see it evolve, right? And part of the usage-based movement is coming from hosting your software that is delivered on the public cloud, right? And that's something I'm seeing here in Alkira. That's basically the lifeblood of our business. And then in MongoDB, we launched a database that was delivered via the public cloud. And the easiest way to price it is through a consumption usage kind of model, right? And so it's just where the world's going. It just makes sense. It makes it easier for companies to figure out monetization strategies and provide clear value what you're delivering, right? Versus something that could be just an unmetered license. So more than happy to dive more into it, but that's the high level trends I'm seeing right now.
So I definitely agree with a bunch of what Rakib said, but maybe slightly different spin on it, where I think it's, as SaaS companies have become more sophisticated, and it's also like as individual companies, as they go through their maturity, they become more sophisticated and they understand more the value that they provide to their customer, that they want to be able to work out, there's obviously such a high cost to acquire a customer that you have to be able to drive that ongoing growth in that customer relationship. Hopefully the customer gets value from your solution, and in turn, as they grow, you are able to grow with them. And so it's important to have a value metric that is aligned to their usage and the value that they get. But to be honest, like I actually don't like the consumption model. Like I think kind of like going with like a very heavy consumption model is too variable in terms of, it's all good when everything's kind of like going up to the right. But then as soon as you start to hit kind of like we've had over the past 18 months, customers can potentially dial down their usage a lot more. you end up with less runway in which you're able to manage kind of like that customer relationship before it hits you from a revenue perspective. And that's just concerning for me from a business model perspective. But I love it when you've got that combination of like thinking about usage, how that drives potentially tiers that you have, or maybe it's an entryway, like it's a way to be able to have a customer come in through product-led growth and like then drive into a higher subscription with then overages as part of it, a consumption part on top of like a minimum commit. But yeah, I much prefer where there's a minimum commit and then some kind of usage on top. And if I was to think about the proportion of like a customer value that's min commit versus usage, I'd normally like the min commit to be like 70% of the value and 30% usage rather than the other way around.
Yeah, you want to put guardrails in, right? And so a commit is definitely preferable, but to make it frictionless, you start off without commits in some of these models, right? Including my current company, where it's a pay-as-you-go option that's there. That being said, some of our more established customers, they're fine making the commit because they have the confidence in what their usage will be. But there would be some customers who don't have that confidence, right? And so you introduce them maybe on that non-commit basis to onboard them. And if you are confident in your product market fit, the commitments should come. And yes, for me as a finance leader, I want certainty when I'm forecasting my business, right? So in a consumption-based world, forecasting becomes a much bigger challenge, right? And then what I'm hearing from customers, they need their finance teams are also telling them what's our ratable expense. So which is
That's
why
a really good point. Yeah.
Exactly. But then the challenge is the pricing becomes a big challenge, right? And that's where, hey, are we pricing properly? If we do a fixed pricing, but we are delivering on a consumption-based cost basis, how does that equation work, right? So Kriti and I have already discussed this, in our conversations. It's like, there's a beauty to the consumption delivery, but there's pitfalls regardless of how you go do your pricing with your customers.
Yeah, it's like I've done a bunch of pricing strategy work too. It's also part of what we do Exit Point Partners, and like we did a project last year, and a lot of this company's competitors have moved to a pure usage model. They were actually it was like translation software. They were charging, and my dogs are here, by the way. They just keep bouncing. Maybe you'll see them at some point. They charge based on words translated, and we actually did a lot of primary research, talked to customers. And like customers don't like that because they don't have the especially larger companies where they want to have like certainty in their budget line. And so that's also the danger sometimes, or the concern from a customer's perspective is like, what's their own predictability in what their costs are going to be? So then you still have to, if it is pure consumption, you've got to work really hard to help people understand and forecast that themselves too.
Yes, exactly.
That's a very interesting point, and I think it would be great to get a sense of, considering the complexities which a usage-based model comes with and less predictability, which kind of companies should actually go for something like this, which kind of companies should stick to like a SaaS model or go for a hybrid. Because right now, a lot of companies, considering the current macro environment, are thinking of evolving their business model or trying to get to somewhere in middle. So it would be great to get a sense of if there are some parameters that they should look at when they're trying to switch from one model to another.
So yeah, for me, it's interesting because with Alkira, we're delivering our product in the cloud. So there's a variable cost that goes with usage. So that has to be baked into your pricing. And so we have to have a consumption component to build out how we go to market, right? So consumption commit is, I like that a lot, right? Because I think no one is, you're using to what you believe you'll use for the year, and you have certainty for your finance team as a customer. Your finance team is like, hey, we have a confident expense that we could book. That being said, if you use against what you sign up for, then there's that negotiation. Hey, do you either pay us an overage fee versus do you upgrade to a tier that'll get you that next level of pricing that could maybe unlock discounts, right? Those are things you need to think through. But our model, we have to deliver it in a consumption kind of mode, right? A previous company, that wasn't the case, but we modeled the pricing after transaction volume. So every time it's a compliance product. So every time there's a trade happening, onboarding, offboarding, in this case was crypto, they run the software and to see if there's any red flags to that transaction. And we built our pricing based on transactional volume. But then we charged an annual fee that goes back to that tiering. And so that model worked well to help guardrail the pricing for both sides, and it served us well. But you could theoretically go different permutations there and not worry about the cost structure there, right? And when it comes to delivering that transaction, right? There's not an extra data being used per se, right? To deliver that. So then you have a little bit more flexibility on how you price. So that's the way I think each company has to kind of look at what the dynamics are from a cost structure to then determine how flexible they can be on building those contracts with their customers.
Yeah, I think the cost is a really good point. I mean, I've definitely seen SaaS companies in the past where they had effectively kind of the all-you-can-eat model in terms of the subscription without thought to their hosting costs in particular, and whether you end up with large amounts of data storage or processing power, people kind of overconsume and they've had no ability to go and charge that. And as a result, gross margins suffer and they end up looking pretty crappy. So you've really got to make sure you protect against that. I think the other good situation is sometimes there are solutions that you're offering, and maybe this is similar to your past life too. I keep with the crypto one, but like if you are embedded into a transactional service that your customer is giving to their customer, then and sometimes it makes sense that it's just part of their cost of goods sold in a marginal way. So if you think like classically about credit card transaction fees, that is very much like it makes sense that it's part of it's a consumption-based model generally because that's how they are charging their customers. And then you end up becoming like very linked to just like their overall activity. But you're also like really hard to the business when you're doing that too, and it's less easy to kind of like turn off or shut down.
Yeah, no, that's super helpful. That's super helpful. And but once people move to like a usage-based model or a consumption-based model, it also gets trickier to see what my ARR looks like, right? Because in a traditional SaaS, you know exactly the number of seats and you can predict your ARR, as Rakib was mentioning. So how do you look at your ARR versus revenue once you are into a hybrid model or a consumption-based model?
Yeah, on my end, ARR, it's a non-GAAP measure, right? So there's some kind of freedom of movement in how you develop the methodology, but has to be relatively in line in how you recognize the revenue. So that is a challenge. And for us, we go to market with a couple different ways, right? Pay as you go, consumption commit, and fixed, right? So each have a different kind of permutation how we calculate the ARR, right? And so for me, I want to have an ARR methodology that best reflects that. And so in our case, for example, pay-as-you-go customers, they grow pretty, up and to the right now. It's like, once you're on, you're growing. And if anything, maybe some of them might be flattish, but we haven't seen anything retrenching in terms of usage in our kind of early history. And so I've said, hey, for that, it's the last month's consumption annualized. And in my past roles, we've had different measures. We've done 3 months. In one case, I had acquired a 6 months methodology that I changed back to 3 months because I felt 3 months run rate was the right representation to get a good ARR number. And investors have accepted that when I've explained to them the methodology. In this case, confident with the 1 month. And so that's what I've put in because I think that is reflective of what I will book as revenue. So those are the kind of things you have to think about, right? Because in the past with ratability, this is your contract, your annual contract, and that's your ARR. So you're getting different, ways to think about it, and it's not, so there's no set way to go about it, but it should be reflective of your business.
I like the 3-month average, or so like I say, sometimes the 6-month average, just where it's like being able to smooth that, because otherwise you can just get the ups and downs, which, I've always looked at kind of retention metrics in the past, both, like hard cancels, but downsells as well. And then it just ends up being very noisy in your retention metrics, like when you're looking at it on a monthly basis, or it can be. And so that kind of 3-month average is often a good way to smooth out some of the noise. I've also had companies that have struggled in the past that I've worked with, where their annual contracts, we were talking about this before, so there's the annual commit, like here's the large subscription, but then they've got overages that effectively are only metered once a year. And so it's like, how do you then think about that annual amount that gets billed kind of like once a year, and bake that into ARR somehow? You obviously can't take that month. Maybe you have to work out to divide it by 12, but then also, it could lead to an upsell on renewal anyway, to a higher usage tier that kind of continues. So those kind of like infrequent metering of usages, and also quarterly, can be just as annoying because it happens as blips through the year. That becomes fairly complicated, and it requires, I think, just some good thought to have to do it. Yeah.
No, I totally agree. And so then there's other permutations that could happen, where in our case we have a fixed rate on one SKU, but there could be consumption-based add-ons, right? And so then you have to kind of then make sure you're programming that in right now to build that ARR calc, right? And then you start getting complications on what a customer ARR is, because you're getting different revenue types flowing in for just the one customer. So those are things that we're starting to see here, and I think other companies are as well.
Yeah, that's a good point. I was going to ask about that too, Rakib. I mean, do you then look at your retention based on different product types? Because sometimes your retention metrics can get can look a little, like I say, funkier with the usage part. Do you try to use just the retention metrics on the pure commit base, and then kind of include the overages on top, or the usage base on top?
Good question. That's something that I've been noodling on. Right now, I still just look all in, and I take a snapshot. And with us, since it is sometimes we're seeing media expansion after the land, I'm looking at net revenue retention not only on an annualized basis, but quarter to quarter right now. And yes, my take is, even though the commit, if they're over consuming to the commit, that's reflective of revenue that we're going to recognize. So then the ARR should reflect that as well. And it's something that I also think the ARR methodology in the early days, and we're only a couple of years in of revenue generation. You have to take a fresh look at it every year to see if it's making sense for the business, until you get to a place when you're advanced stage, and hopefully you have an IPO in sight. You need to really lock that in, because if you have anything with ARR in your S1 draft, for example, it has to be rock solid, right? And so for me, these days, we take our kind of best shot of what the business looks like, and you have the methodology, and you review that pretty constantly. So this is one where, Dave, I do think you're onto something, where we want to show the strength of both what's committed to both the board investors, but also then the magic of that expansion. And then you have to get cohort behavior of your customers to show that, hey, some of this expansion becomes committed the next year, right? And so it's not like it's gonna just go away. It's like, hey, we've actually built this solid base, and now look at this. We've now committed them to this higher level because they realize that's what they need to do. And then, that's where you have the negotiations. Hey, you'll get a couple more points of discount, right? And you kind of lock that in, and that gives that certainty for both sides, right? That's the holy grail, I think, of companies who are in this model.
Yeah. You want to drive them towards that, and then it is interesting then from an ARR metric perspective. Sometimes what can happen around renewal is, where they've had the usage at a slightly higher price, you'll bake that usage into the new commit, and it actually ends up being a lower price than what the current ARR is. So actually, it should be something that's celebrated, but it can actually look as churn. It can look as downsell. And then that's the tricky part, by recognizing all of that monthly ARR, or all that monthly revenue as ARR in one go. But I like your point, Rakib, about the fact that this is, one, it's a non-GAAP measure. to like being open to the fact that you might refine your methodology over time. So like think about that early in terms of your data and how you are prepared for it kind of going forwards, so that you can recast if you want without turning it into a massive exercise.
Yeah.
So how do you capture your data in a way that you can continue like at a good granular level where you can look at it in different ways and not just be driving it off, say, recognized revenue or total build amount from a customer on a monthly basis.
Yeah.
Great.
Yeah. So at Mantis, we work with a lot of usage-based companies, and what we have seen is that people actually look at their ARR in different ways. So there's contracted ARR or committed ARR, and then there's billed ARR, and then there's recognized ARR. So what that lets you do is take care of fluctuations in some, take care of, to your point there, we mentioned where it might look as churn in case earlier it was something else. In contracted ARR, that you can show that it's actually not churn, it has increased. And in build ARR, you can show a different story. So that's been helpful. And then there are other metrics like upgrade, downgrade, which people can look at. But yeah, I think that's the other thing that I would love to understand. So apart from ARR, what are some of the other metrics that you have been measuring or investors have been asking for around revenue, which have been like super helpful for you?
I think I mentioned one already with the net revenue retention,
Yeah.
right? You want to show how your customers are growing as a cohort, and so the added wrinkle for me at Alkira is I'm showing quarterly growth because we are seeing expansion quarter over quarter. Usually, I'm used to showing NRR annualized, so it's actually given more insights to the board to be like, hey. Like they always hear about expansion, but they're never clear if it's year to year or if it's happening within the year. So that's surfacing that up. They appreciate that, and then we're starting to do some of that cohort customer analysis, right? Where how does a cohort coming in? How are they trending over time? Again, we don't have much history, but that's something we're going to continue to build on. So then we could hopefully show that there's continued expansion strength even beyond year one, and how does that look? And then you look at it from an economic perspective, right? Because it's very expensive to land customers. But as you expand, that's cheaper acquisition of new bookings, if you will, right? Because you're not paying for a lot of the work that's done to acquire that logo, and now you're getting efficiencies. So you want to show that. So that goes into like the LTV to CAC type of equation, right? So LTV, lifetime value, that helps, that accounts for your churn, right? The LTV metric, and also how well you're doing from a gross margin perspective, and then how much does it cost to acquire that customer. And there's in a software world that the 5-to-1, 6-to-1 ratio is considered to be best in class. So if you're above that, that's means that you're doing this efficiently. You're acquiring your customers in an efficient way. So those are things we take a look at. There's other things that go more towards that bottom line efficiency as well that the board looks for these days. But those are the ones that come up to mind for me from a revenue perspective.
I'd just add from a retention perspective, I think gross retention is still like really
Oh, yeah.
important. So, excluding upsells and downsells. And then we also used to look often at the private equity firm I was at before. We would look at what we would call punitive retention, which is effectively all downsells and cancels, excluding upsells. So it would just show kind of like what's the overall reduction that's happening in the ARR base that then you're having to like top back up, whether that's through new business or whether that's through upsell. Them were like useful in terms of looking at just like the overall health of the business. I think the cohort analysis is super helpful. As there's lots of, I think, challenges for many companies to be able to do that well, and you've really got to think about that from the beginning. But it really is super helpful, and then being able to link, think back to maybe like changes in the business that happen, where maybe there's a different approach to onboarding at certain times. Maybe there's a different approach to like customers that you're going to sell to, where you might actually then see different retention rates that happen. Sometimes we actually sell to customers that prove to be like not good customers that we want to be pursuing in the future. So having a way to be able to like have the cohort metrics available and be able to think about linking them to potentially expansions or changes in strategy that you have is good. And as you get bigger, I also think it's super valuable to be able to look at your ARR data by the different products that you offer, because it will also highlight different things that's going on, different dynamics in your business that you want to be able to focus on, where you may find that there's either a product that you really want to be doubling down on, or there's something that actually you probably should be working out how to sunset.
Yeah. Yeah, and I think some of the other dimensions also that some of our customers look at are by industry, by region, because if you're focusing on like these different regions, that also can give you great insights. And how do you see these metrics also evolving at different stages? Dave, you answered this a little bit, but the different stages and for different kind of models. And Rakib, you and I have discussed how for usage-based companies, combining usage data and revenue data can give you like a lot of insights. So how does that evolve according to stage and type of business model?
I mean, I think quite often for early stage companies, they just want a number. They just want to be able to like do it without turning it into like days of spreadsheet work or like a manual activity that somebody has, and they want to focus on accuracy. So quite often at the beginning, just like how do you have reliability in your data and you're able to produce the metric fairly efficiently, be able to share it with your CEO on day 1 or 2 versus on day 10 once you've finally kind of closed the books. As you then grow from there, and especially if your business model is more complex on the consumption side, I think you have to really think about it as part of the business metrics in terms of like what can you be producing on a very timely basis with more of this layered analysis, either by cohort or by different kind of line of business or different geography, as you were saying, VT. So it's kind of like then linking it back to just what's the overall strategy and importance for the business and how you want to measure performance. But it's, I think in the past it can be seen as being like a metric for investors, or it's a metric to kind of like just measure overall progress against. But really, like it's got to be that metric for how you run the business. It's not just because it's great. It brings together bookings, it brings together delivery, and it brings together like customer success all into one place, and like really helps you understand the dynamics of your business. And that's where you've got to key it to like the strategy that you're trying to go and execute against. And I don't personally see enough companies doing that. There's still like many companies that are basically, way too big to be doing it in Excel, but they're doing it in Excel through brute force just to be able to get to like some view of numbers.
Yeah. And to add, I think I agree with everything you're saying, Dave. And then early days, you want to show precursor data towards AR generation. If you're not like you only have a couple customers, say, and you want to kind of model out what the world looks like based on your pipeline, right? And you want to project, if you think this is a land expand business, make sure you sketch out that vision in a way that it's clear. And then once you get to some scale, which where we are right now in Alkira, you're already showing what art of what's possible, but you would still want to project what your current customers could be doing in a couple of years, along with how do you plant the seeds, continue that virtuous cycle, right? The land expand lifespan, right? So where you're planting the seeds, that's one cohort. The other one's kind of going on that journey. And so now you have some data points that you want to make sure you project. But that being said, as Dave alluded to, doing this on spreadsheets, it's tough in this world, right? And that's where I think we're talking, right, Kriti? I mean, I think Mantis could help solve things like that, because for me, it's slicing and dicing the different kind of permutations, as Dave alluded to, is going to be tough on a spreadsheet, because I want to understand based on a customer's usage, how different each customer is, and then they might have their own kind of expansion journey that I want to show to investors. And so eventually, industry could play a role, right? Like certain industries could go on this curve, while the airline industry could be like this, but like this conglomerate it goes this path, right? And so those are things I'm starting to think about now. I don't have the tools right now to do it, right? But this is going to be a world that needs, I think, real prescriptive tooling to help paint that picture of what's possible for that from that ARR growth perspective.
Yeah, and that's really important. Is because I think a good sales organization will think about how they segment their customers and kind of like segment their sales team too. And then quite often that just doesn't then flow all the way through to the rest of the life of the customer. And being able to enrich your data with kind of like outside in information that gives you characteristics of the customer, because industry might be good sometimes, but maybe you need to like be looking at it like with some other characteristics related to the customer that can like actually provide really useful information without it turning into a project on the basis of a hunch at some point in the future, which is quite often what these types of analyses originate from. So yeah, I think that's really important. I also, I think contract type is also really important too. Sometimes where it's like, for one, kind of are these month to month, annual, multi-year contracts? How does kind of your ARR perform based differently on contract types? But especially knowing when you're selling to enterprise customers, quite often they want to like sign multi-year contracts and get to commits, and then being able to like clearly understand how much of your customer base is potentially eligible for price increases is really important, because I didn't mean to do that thumbs up. I just did it on it. Quite often, you can't do any other than the contractually obligated price increases within a term. But you may have introduced a lot of new features. You may think that your value is higher, and that you can go and like drive more ARR through price increases, which should never be overlooked. I think is kind of like part of the NRR increase journey. But you can't do it for 2 years for like half of your base, because you had a really good year last year selling 3-year deals, and then that's got to like get into your forecast, and it's got to get into like the way that you're thinking about the business going forwards.
Yeah. And actually, I think both of you touched on the forecasting piece a little bit, considering the planning season was just around the corner. Would also love to get a sense of how do you think about forecasting in terms of frequency, and considering predictability is so difficult, and again, hybrid models or usage-based models. What are some of the best practices that you have seen or you have deployed in your current company, in your previous companies?
Yeah, I mean, in this world, you want real-time information, right? And our leadership, our CEO, like loves to look at where ARR is at any given time, but right now it's a manual process, right? So for me, real-time forecasting, on the ARR side, that helps us then dictate our revenue recognition, and getting the P&L forecast updated on a fairly regular basis is where I want to guide things. Right now we haven't fully launched it, but a rolling forecast is usually my preferred methodology, where you're moving at 24 months, and the current 12 months is always where you have the fidelity on the bottoms up, but you have a view 12 months out, and that's where that trending analysis is going to be important from a customer perspective, right? And so for me, having real-time dashboarding on our ARR based on the latest usage is one of the things I want to solve for, right? And I'm hoping to work with you on that, right, Preeti? And then and there's going to be just other things that I need to do for the rest of the business to forecast on more regular basis. But forecast is a living, breathing thing. So once you have the plan, you're already starting to go into forecast mode. So every month you do a fresh look at everything and see where you are.
Totally agree. Like, to me, your forecast should be done every month, whether you have to like show that to anybody or not. As a CFO, you should be forecasting your business every month, because that way you get a view of what your risks and what your opportunities are. I think ARR forecasting for most companies is fairly simple, and it's because the way they look at ARR is fairly simple. And so as you are, you're doing that kind of like manual production of ARR each month to look at like what your number is. You're then forecasting the business going forward. You spend a lot more time thinking about what's the bookings forecast. And then you've got some assumption on how your bookings forecast is going to roll into live customers. and you've got some assumption that's probably based on current history on churn going forwards, and then being able to like put that through a waterfall or a snowball is pretty straightforward for forecasting at the simple level. But if you've got more insights into actually what's happening for the various segments of your business, the various, dynamics that can happen in your business, then like your AR forecasting could be a lot more insightful about what that really means. It does, like, it pushes the problem a little bit upstream, where you've also got to be able to forecast usage well, and people may not have the full dynamics for that yet in a usage-based business, but then that in turn will provide just better, rigor around how you run the business. But like, so you've got to be able to get the good inputs to then to be able to drive better, kind of like more rigorous forecasts in the future. But I think that's always the right thing to do as the business scales and matures. But yeah, I do think that, like, you ask most CFOs, they're like, how difficult is it to forecast ARR? They go, yes, kind of easy, but it's because they're doing it at a pretty simplistic level.
Yes.
Yeah, because one question that we've gotten asked by a lot of these, again, usage-based hybrid companies is, how do you take care of seasonalities, trends when you're forecasting? And a bunch of times when people do it at a customer level or at a cohort level as compared to at a company level, when there is a traditional SaaS business or a pure SaaS business. So that's the complexity, at least, like we have seen, and would be great to get a sense of how do you then cater to that when the ARR is not that straightforward, or ARR every month is not that straightforward.
Yeah, I mean, there's no silver bullet. Dave, I think you.
No, I was just gonna say, yep, I can understand how that's challenging.
Yeah. Yeah, I mean, it's for me right now. Yeah, this is where, I think we need a systematic solution, right? Because we're gonna have different permutations of how ARR is calced. As I mentioned, one customer might have a fixed and a variable component, and it's gonna be rules based. And right now it's a very manual exercise, right? The team has to, right now it is an end of the month exercise to get it updated. I would love that to be real time. So I want usage to be flowing in to a system and then spewing out based on our methodology. This is the current ARR, and then you couple that with the longer term analysis, trending analysis, right? Where can you provide where do you think the customer go based on the underlying usage data? So that's in theory what I'm chasing. That you have real time ARR based on current usage, and then that usage analytics helps project. Then there's other elements, right? Because part of selling, you need the sales capacity, you need the pipeline. So how do you marry all that together, right? And so in a usage-based world, it is fairly complex, actually, right? So if you want true, I think detailed forecasting is backed by what's going on under the hood, it's going to have to connect to different parts of your business to project out that ARR, right? Because it is multiple things that need to be validated to say, hey, this is the ARR forecast.
Do you see a typical ramp in your customers, Rakib, like an individual customer, how their usage changes, or do they?
Yes, I think it's not the same for each customer. Some of them are rocking and rolling right off the bat. Some of them take a little while, right? And so that's something I need to get smarter on as well, right? And see is there something that we could actually project. And then, when you have consumption commit, you're like, hey, they're gonna have to use it at some point, right? So, but there's there's different revenue recognition things that come into play based on how you build those contracts as well. So that adds a layer of complexity. I think that's like another podcast on its own, right? On revenue rec, but because that is it could really change based on how you build the contracts, right? For example, if you have the commitment over a couple of years, you're going to get into consumption-based revenue rec, even though there's a commit, right? But if you commit for only the year, you could do a ratable recognition for the most part, right? So those are the things that come up to play. But then you have to match that against what your customer needs, right? And so those are things like, hey, as a finance guy, I could be like, hey, get that commitment by year. But then I might hear back that the customer absolutely doesn't want to do that by year. They want it for the 2 years. then it's a purely consumption-based revenue, right? And so you lose the
that's
rest.
tough. Yeah.
Yeah.
Honestly.
So so those are the complexities, but that's one thing on the business side. But it is a hard thing to quantify and show in reporting, right? Like here are the contracts we have in-house. This is the live ARR versus what's contracted, and then here's what's actually being recognized, from a revenue perspective versus not because of XYZ, right? Because the way things are set up right now, and I think it's not going to get any more simple because we're in a pretty complex software space. I'm going to have to unearth these insights in a way that's easy to attain, right, and digest, right? And right now it's not the case, right? Because there's not a systematic solution for this right now.
Perfect. Is there anything else that you think we should cover? I think we covered the reporting part a little bit, forecasting part a little bit. Anything else going to you?
Dave, anything on your end? Yeah, I think this is from
Quite
a
a
ARR
lot.
perspective. This I think this might a lot of interesting things happening from how we're going to market, and then just making sure that our ARR reflects the business properly, right? And so for me, it goes beyond the ARR, right? It goes all the way down to the profitability, and then so one of the things I'll be looking to do is understanding on a customer perspective the profitability, right? And because it is a usage-based delivery, and how much variability do I have by customer, right? So that's something that starts at the ARR, but you have to kind of get through to the cost structure and understand, hey, like, are we pricing properly? So it becomes this feedback loop, right? And so that's something that I'll be looking to really crack the code on, if you will, this year. And I'm hoping, it's like, I know, Kriti, we've had these conversations. The ARR, it starts with ARR, but a lot of the data that'll flow through a Mantis could potentially help with that that bottom line efficiency analysis as well, right? Because the same data that could help project your usage base will also help project your cost base, right? So that's going to be an area to explore this year.
The only thing I would add, and you touched on that a little bit, Rakib, but like ARR really needs to be understood by all the business. Quite often it's kind of something that's really just understood by a few people. But kind of in previous roles, I've trained people like within engineering and product and sales and marketing, just like how ARR retention metrics work, and like what it means for when you're contracting, and like how that then drives what is effectively the most important metric for SaaS businesses. And it was always kind of surprising how little they knew and how little they understood. So I'd definitely always suggest to finance people to get out and like proselytize on ARR and actually talk about how it works. Some of the things that you were talking about, like annual commits, like multi-year commits, and like then just getting people to understand how that then drives results, because it is surprising somehow. There can be potentially different ways, and people have different ideas in how you can actually engage with customers, contracting customers, that will help you achieve your ARR goals faster, without too much additional pain towards a customer, and still
No,
having
exactly. Sometimes customers might be willing to do what we need, and we just don't know until we ask, right?
That's right. We negotiate with
assume what the
ourselves.
customer wants is what
Yeah.
we have to do. But hey, like it's worth asking, and sometimes even explaining how it could be beneficial for both sides, right? And being transparent about that. Because the feedback I've gotten from some customers directly was that, hey, we need ratability in our expenses. So then now we could find some common ground to build that contract that could achieve what we need to achieve, and they're happy, right? So those are things that it's and then as my mantra as a finance leader to my teams always is like we have a real capability to help drive the numbers, right? And it's not just, we should not be reactive. And one of the areas is building these contracts, and then you optimize for what's best for both sides, right? And that's something I think is key in this whole equation.
Yeah, and related to that too is like there's for many businesses as well, there's a real trade-off to consider between like more consumption. Sorry, now I've got balloons. I don't know why it's doing that. More consumption to drive more revenue versus like actually getting people to pay their contract annually upfront. Like the cash benefit of getting kind of that upfront can be extremely important for
especially early
many.
days. Yes.
Yeah. And as you, if you want to look at cash EBITDA versus, like GAAP EBITDA, even though it's not a GAAP measure, then, like that actually can help you as you're looking at your Rule of 40 as well. So
absolutely.
think
Yes.
about that
Yes.
and get people to just understand the financials is really.
That was a conversation topic in our sales kickoff, actually, that dynamic. So you're definitely spot on with that.
Yeah. Cool. This was great.
Yeah, perfect. No, thank you so much for doing this. This was super, super helpful.
Pleasure.
I learned a lot. And yeah, looking forward to sharing with everyone.